Hello viewers, welcome back to our YouTube channel, KC Accountants Education Center. And today we want to continue with our series of advanced financial management. And the previous video I talked about things to do with gearing and the cost of capital. We looked at the impact, but we want to first understand what gearing ratio is all about before we can be able to pick a practical question where we shall be able to do a computation about the financial risk, gearing that is related to financial risk. So let's first understand what gearing ratio is. So gearing ratio or leverage ratio. Now, how do we measure financial risk for a company that is geared? For a company that is geared. So this is basically what we are trying to answer. How do we measure a company? How do we measure financial risks for a company that is geared? Now, one way of measuring financial risk for a geared company is by using gearing ratio, and most importantly, the debt to equity. The debt to equity ratio. So debt to equity ratio, or by using what we call the interest cover. These are ratios that we studied in our advanced financial management. So one way is to use the gearing ratio, and the gearing ratio is mainly debt to equity ratio or the interest cover ratio. However, there is what we call financial gearing. Now, financial gearing shows the relationship between shareholder funds and the prior charge capital. So the financial gearing shows the relationship between shareholders funds and prior charge capital. That's what we call financial gearing. Now, there is also what we call operational gearing. Now, operational gearing shows the relationship. This one shows the relationship between contribution and profit before interest and tax. So operational gearing shows the relationship between contribution and profit before interest and tax. We know that contribution, we know from the fact that contribution equals revenue minus total variable costs. Total variable cost of sales, that's when we'll be able to get the total contribution. Now, let's now focus on the exam. Let's put our focus on the exam. So, the examiner will come out clearly to tell you either to compute any of the above, gearing ratios. So it can tell you to compute financial gearing ratio or what we call the operational gearing ratio. But for you to be able to compute those, then you need to know the following. One, this is something that you should know. You need to explain the ratio after making some computations. So you have to make explanations for any ratio that you have computed. And then you tell us the level of gearing. You should explain the level of gearing. In other words, you tell us the level of gearing and you be able to explain the computations that you've made. So, after explaining the level of gearing, whether you are going to move forward or you are not going to move forward. Two, because we have got very many formulas for computing financial gearing, then we need to take note of the different formulas that we have for computing what we call the financial gearing. So we have very many formulas. Now, financial gearing, let me just use FG to mean financial gearing, just to create more space. Financial gearing equals prior charge capital. Prior charge capital over equity capital. This should also include reserve, including reserves if they are there. So that's one method. The other, you could use prior charge capital over total capital employed, or what we call the net assets. The net assets. You know, capital employed is net assets. But now we need to understand what this means, prior charge capital, where prior charge capital, so we need to understand prior charge capital is the one that has a right to the receipt of interest or preferred dividends. Prior charge capital is that capital that has, it's the capital that has a right to the receipt of interest or preferred dividends. Preferred dividends in a precedence to any claims on distributable earnings. Distributable earnings on the part of ordinary shares. In other words, it's that ordinary share where you have a right to receive dividends or interest. It's that capital where you have a right of receiving dividends. Two, it can also, the prior charge capital can also represent the prior charge capital. Prior charge capital can include, 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 prior can also include or exclude minority interest. Minority interests, deferred tax, and deferred income. So we exclude this item. These items are supposed to be excluded from the prior charge capital. We are supposed to either include or exclude based on the scenario that they have given to you. So we should exclude things to do with minority interest. Minority interest is from the control perspective, where an organization has some level of control in the other. So you need to be careful, because that information will be available in the financial statements, specifically the balance sheet. So you may find that you have capital in the balance sheet, because I'm trying to explain the prior charge capital. If you may find that you have capital in the balance sheet, but you still, on that same capital that you have, you will not pay any interest on it. Neither you will pay any dividends. Like, for instance, I can have capital. Let's say I have debt, but that debt I'm not paying it. I'm not paying it. I may have shares, but those shares I'm not paying dividends. Maybe someone gave me the money. Venture capitalist, he said, just take the money, do the business, bring back my money without any interest. Maybe it's a loan, but I don't pay any interest. Someone gave me the loan, but when I get back the money, I take it the way it is, minus paying any interest. So that can't be included, because I will not be able to pay or even pay interest or even pay dividends. But I'm using that money in my capital structure as my capital. So those things, they will be in the financial statement, and that's why I'm highlighting them, that if you see them, it's upon the examiner telling you that this is this that you can include. But if you are not told, then you should exclude them from what we call the prior charge capital. Prior charge capital, we said it is that capital where you are going to pay interest on it, or you are going to pay dividends on it. If it is shares, those shares must be able to receive dividends from where they came from. And if it is a loan, you must be able to pay interest on that loan. So you can see that when you are computing the financial gearing from the formula, we are trying to look at, you see that we are trying to look at the prior charge capital, this one here, the prior charge capital over the equity capital, or over the net assets or total capital employed. So when I'm computing the financial gearing, I'm looking for prior charge capital. Technically, that is capital that has a right to receive interest, or you are supposed to pay interest on it. Of course, if you're not paying interest, you are going to be paying dividends, as long as you're using it as the capital. So you are either going to be receiving or you are going to be paying out either a dividend or an interest. And in most cases, the order doesn't matter. As long as you look at a certain amount that you are using as your capital, but that figure you are paying interest or you are paying out dividend, then it's supposed to be included in the prior charge capital. But in the case of a company, because there are instances where the company is maybe winding up, they are liquidating the company, and in line with, let's say, the credit hierarchy, because we are saying the order doesn't matter, but there are situations where if the organization is winding up or they are liquidating the company, the order matters, because we get from the credit hierarchy who is supposed to be paid first. There is no way you are going to pay the shareholders minus paying those debt holders. You first clear the debt component, and then the shareholders will take what has remained after clearing all the liabilities that were there. So most of the times, if you have companies that are winding up, they are going to be paid according to their claim to the prior charge capital. So this is where the examiner will confuse you, where he might say, maybe he might put the capital in the balance sheet. You see that you have one item of capital, but you are not going to be paying interest, or you are not going to be paying dividend on it, and they are calling it capital. So if you are not going to be paying interest or you are not going to be paying dividend, then it shouldn't be included in our prior charge capital. So one of the things that we talked about, we looked at the deferred taxes and deferred incomes. So if let's say you have not been paying, let's say, taxes for 3 years, if you have not been paying taxes, then it's going to be a liability. You have accumulated some money because you are supposed to pay, but you have not been paying. So you are going to have a long-term liability that is going to be provided in your balance sheet as a long-term liability. And of course, you know that you are going to be paying interest on that, because if you don't pay the taxes are going to accumulate some interest. It's like you have reserved the money. You would have paid that money, and it goes, the other interest doesn't come in. But since you remained with the money, you didn't pay, so interest keeps on accumulating. So once you know that you are going to be accumulating interest on it, or you are going to be receiving, because it may be an income, you are going maybe to receive interest, then it's supposed to be included in our prior charge capital. But if you know that there is an element where you are not going to pay interest, or you are not going to receive it, then it must be excluded from that prior charge capital. But also, prior charge capital could also include or exclude what we call minority interest. We said minority interest, deferred tax, deferred incomes, they can be included or excluded depending on the scenario they have given in the financial statement. But just know some of these, they are either going to be included, some are not going to be included. So as long as you are not going to pay interest on them, like maybe for deferred revenue, deferred taxes, And that's ideally what we want to consider, unless you are going to be prompted by the examiner, as we shall see in some of the practical numbers, because the examiner can tell you, maybe he gives you a note, he gives you the balance sheet, then we have some additional information where they are telling you you are going to be able to be paying interest. Now, for a company, being geared is not a problem. But if you are gearing, this is where we are going to get the comment, what we are going to comment on our results we've computed. After getting the financial gearing, we need to compute and explain. So we have no problem with the company being geared. But the problem is that if the company is so much into debt, it's going to bring what we call the financial risks. And now we are going to compute this financial risk, or what we call the financial gearing, in percentages. The result, the end point is going to be either it can be in percentage, or you can compute it in decimals. Now, if the gearing is above, when you're making the conclusion, if the gearing, because we are talking about the financial gearing, is above 100%, then we can say that that company is highly geared. But if you are below, this is above 100%, we say you are highly geared. But if the gearing is below 100%, then that company is not, we shall not have any problem with that, meaning it's not all that geared. So we are going to try to look at some calculations, but the examiner is likely to specify, in other words, the examiner most of the times is going to be specific on which formula to use for computing the financial gearing. And we are going to look at how we can be able to compute that based on all these formulas that we have. Then it will be upon what the examiner brings that we shall focus on. But there are scenarios where the examiner might not give you the exact formula to use. So if the examiner doesn't specify which formula, then you base on the information that has been given to you in the question. Because you may find you are prompted maybe to use another formula, but looking at the information you have, it can't allow you to use that same formula. So you base on the information that is available. So we are going to look at, maybe in the next video, where we're going to look at the practical simulation, so that we can be able to understand what we are doing and be able to make a comment, because we've said it's not all about making computation, but it's all about advising based on the results that we've got. So let's meet in the next video as we are talking about the simulation that we are going to have, so that we can be able to illustrate what we have discussed.